Joining us now, Ed Yardeni. He's the president of Yardeni Research. It's good to see you.
Thank you, Scott.
What a remarkable turn, huh? Since we're down 5% or so on the S&P, wondering whether we're going to have a 10% correction from there. And here we are, less than 1% away from another new record high. What should we make of this?
Well, it's clearly still very much of a bull market. I thought we could have a 5 to 10% correction. We had something a little bit over 5%. Looks like we're not going to have anything like 10%. I think what we make of it is that the economic outlook remains really quite positive. I think inflation is going to continue to moderate. I think the economy is going to continue to grow. And I think that means that earnings are going to continue to head up, probably not to a new high in the first quarter when all numbers come out. But I think over the next couple of quarters, we're going to make new record highs in earnings. So I see the market moving higher.
I mean, let's kick earnings around, if you would.
Sure.
Because I know where the outlook is, but if you look at what just happened in earnings season, and it's for all intents and purposes over, the growth was all from the mega caps, right? I mean, what are we going to do? Less than 5% total earnings growth, maybe around 5%. But the majority of that really came from a very, very select group of stocks. Why should we believe that that's going to turn?
Well, we are quite optimistic on overall corporate profits. Last year, they came in at $222 per share for the S&P 500. We're thinking $250 this year, $270 next year, and $300 in 2026. And the reason for that is I think profit margins are going to continue to expand to all-time record highs. We have seen profit margins going up, and you're absolutely right. Some of that leadership and higher profit margins have clearly been from the mega cap names. But Scott, it is what it is. I mean, we're talking about roughly 30% of the S&P 500 market cap being dominated by eight names, and they're not going away. And they're going to continue to be an important part of the market. We got a forward PE of about 21 with them, and we got a forward PE of 17 without them. So the market doesn't look cheap when you look at the overall market, but then you got to consider what you're getting for your money, and you're getting some pretty amazing companies.
What about the sector shakeup, if we want to call it that? This week is good evidence of it, right? The sectors that have done really well this week, and technology is not going to be mentioned by me, other than telling you that it's not in there. What do we make of that? Do you believe in this broadening finally and for good? Because I've asked you and others at times when we've broadened out and it's fizzled. Will it this time?
Well, I think part of the broadening issue has been that the mega cap 8, as I like to call them, I watch a lot of movies, so I'm throwing Netflix into the mega cap 7, and a lot of those stocks have really seen their price appreciation, stock price appreciation so great that by comparison, other stocks that are up maybe a piddling 20% since the beginning of the bull market don't look all that exciting. So a lot of the breadth issue has really been just a mega outperformance by the mega cap stocks.
Yeah, but I mean, I'm thinking like utilities this week, financials have done incredibly well.
Sure.
When you look at utilities, most people look at utilities, they say, well, it's a yield play. Right. That's where it's defensive. Now I hear the overwhelming majority of people suggest now these are just more AI offense plays. And
absolutely,
others would suggest, well, that's going to end in tears. Now we've taken utilities to the point of their AI plays too?
Well, I think I've mentioned to you before, my pet thesis here is that all stocks are technology stocks. You either make technology or you use technology. If you don't do that, then you're out of business. You're going to be competed out of business by companies that are using technology or making it. And so, I think the market is actually broadening out in a way that makes a lot of sense to me. Utilities clearly are going to be big beneficiaries of tremendous demand for power to power the data centers and make this all work.
And the notion of, what we heard today from the Fed speakers who are out in force, which certainly tilted a little more hawkish. Now, the Fed chair obviously didn't, or at least that's the read, assuming we're reading that correctly.
No, you're right, I think.
What do you make of that?
Well, look, I don't think the economy needs any change in rates. It certainly doesn't need rates to go up, and I don't think it needs the rates to go down. I think we've normalized interest rates. We're back to where interest rates were before the great financial crisis, before the great abnormal between the great financial crisis and the great virus crisis. So I'm very comfortable with the rates here. So the stock market seems to be very comfortable with it. I am concerned that the Fed might just take any bit of evidence that the economy is slowing and lower interest rates. And my concern would be that that would be too much of a good thing. We could have a melt-up situation in that scenario. So I'm rooting for things to pretty much remain even keel here, and I think that'll remain very positive for the market.
Are we giving too much credence to the notion that the consumer is just going to hang in there forever? Because the data this week was squirrely on that front, and if you put Starbucks, the recent earnings report, into the mix, and some others too, I'm not necessarily sure that we come away from all of that feeling great.
I think the consumer is got a lot of different stories in the consumer. It's not just one story. I think you've got a lot of baby boomers that are retiring, and the baby boomers have $75 trillion in net worth. It's the richest cohort of demographically that we've ever had. And they're spending money like crazy. They're going on tours. They're going to entertainment venues. They're going to restaurants. They're traveling, and they're going to the healthcare system. And that's creating a whole bunch of jobs in all those kind of services. On the other hand, you do have people that are struggling with consumer credit, and a lot of them are actually younger folks. And I think what we're missing here is there's a lot of intra-generational support going on, where the baby boomers, I think, are paying some of the credit card bills and some of the mortgage down payments for the younger generation. So I know this from a personal experience, Scott, but I also know it's from my friends.